All right. Hello and welcome. My name is Shannon Williams. I'm the Chief Executive Officer for the Home Furnishings Association. And today is probably one of the most exciting webinars that we have to share with you. We're doing State of the Industry, how we're going to navigate some economic trends and some market shifts. We have Piper Sandler here joining us. So today we're really hoping to kind of look at what's going on with the current economic climate, how to identify some emerging trends and some opportunities within our industry, and then where can we explore some potential implications of this upcoming election. Just a reminder, this webinar is being recorded and it's available on demand at myhfa.org/webinar. I'm sure you're going to have a lot of questions. Please put them in the Q&A box at the bottom of the screen. I'm going to answer as many as time allows or feed them over to our panel of experts. Before we get started, I'd love to thank Synchrony, who is our education thought leadership sponsor. And before we get started, I don't know how many of you guys have had a chance to meet with Peter Keith or Dave Wigglesworth, our economic team over at Piper Sandler. They're absolutely incredible. We've had a several-year relationship with them, and they are our economic team that helps us at our Top 100 Summit. So this is the team that's really guiding and looking at what's happening on that Top 100. So first we have Peter Keith, who is the managing director at Piper Sandler. He's a seasoned retail expert and has over 2 decades of experience really just analyzing hard lines and leisure companies. As the managing director at Piper Sandler, he's really known for delivering key insights that help retailers stay ahead of market trends and offers actionable intelligence to navigate industry shifts and drive growth. So his forward-thinking perspective is definitely going to give you something to walk away with today. Don't leave here without asking questions. He is a wealth of information. We also have Dave Wigglesworth, who I just had a chance to meet a couple months ago. He is the economist and data scientist at Piper Sandler, and he's an expert in uncovering the story behind the numbers. He's an economist and data scientist over at Piper Sandler, and he combines cutting-edge quantitative analysis with big picture macroeconomic insights. He's the mastermind behind the EcoQuant series, which I have referred to as the sexiest book series that there is available, and translates complex economic trends into practical strategies that retailers can use to thrive in today's market. So whether you're here because you want to forecast economic shifts or really how to turn data into actionable insights, Dave's going to be able to help us do that as well. So I'm going to turn this over. This is going to go a little bit different. They're going to present what they're seeing in the market, ask questions in real time. We'll stop them and get to as many questions as time allow. But Dave, Peter, thank you for joining us and take it away.
All right. Well, thank you. I'll just say thank you to Shannon. Thanks for everyone for joining us. I will say, Shannon, that's one of the best intros I've ever had. Dave maybe feel the same way. We did not write that, so thank you very much for the kind words. But more importantly, we've really enjoyed this partnership that we have with the Home Furnishings Association. It's been going on for a number of years now. So we've done a series of these webinars, and it's been a very dynamic environment the last couple of years. So there's always new stuff to talk about, and certainly the in-person events that we've participated in have also been some of the highlights. So the structure for today is real quick. Dave is going to start, basically talk about the macro, and then I will go next and I'll talk about the micro. So Dave will look at the larger picture trends. I'm going to dig into some of the industry specific trends and even some of the company trends overall. Shannon may jump in with questions that she sees throughout the presentation, but we're happy to answer questions during or after our slides. So with that, Dave, I'll turn it over to you.
Yeah, thanks, Peter. So I guess I'll start in my first slide. I guess, can we skip to the next one, actually? Thanks. So hi, everyone. A lot of you are probably interested in hearing about the Federal Reserve, and you might have heard in the news that it just started to cut interest rates. To me, the news isn't so much that the Fed is cutting interest rates, it's why they're cutting interest rates. And there's 2 reasons, really. One is that the Fed's inflation target has basically been met. You won't hear that on the news. They tend to look at a specific metric called CPI, the year-over-year percent. But the people who work at the Fed, the governors there, Jerome Powell himself, they say that they like to look at inflation in terms of this metric called the core PCE, and they like to look at it over the last 3 months and over the last 6 months annualized. And those numbers are slated to come in at exactly 2% this month. And so the preferred way of looking at inflation from the Fed's point of view, is at the Fed's target. Inflation is not the problem right now. What is a problem is unemployment. And if you look at the right chart here, I guess some of the labels went missing, but what I have here is this blue dotted line, which is the unemployment rate, and I flipped it upside down. And the orange line is the interest rate that the Fed controls, which is the federal funds rate. And what I really want you to notice is that in the past, and indeed today, what you see is that the Fed tends to lower interest rates aggressively when unemployment is the problem. Not necessarily because inflation has made it back to the target. It's usually more than that. It's that the unemployment situation is heading the wrong direction. And indeed, it is right now. Just skip to the next page. Based off of the historical leading indicators of unemployment that we have, we think that we could have an unemployment rate that goes to 5% by the middle of 2025, or maybe even 5.5% by the end of the year. Now, that's bad news. Of course, for context, the unemployment rate was 3.5% 14 months ago, and it was just 4.3%. So we're kind of going from 3.5 to as high as 5.5. So that is bad news. The good news, though, is that while we expect consumer spending to bend a little bit, we don't expect it to break. And if you look at the next slide, you might be thinking, how the heck can the unemployment rate go up 2 whole percentage points, which is over 3 million people, affecting over 3 million people, and have consumer spending not collapse? Well, it's because even though the Fed has been tight over the last couple of years with high interest rates, the fiscal side of the economy, the Congress, the president, the federal budget deficit has been very loose. We are running $2 trillion deficits, which are 7% of what we put out in economic output in a year. We are building new chip factories with government subsidies. We are forgiving some student loans. We're increasing defense spending. A boatload of people retired during COVID, so there's renewed stress on entitlements. Interest on the debt this year will be $900 billion alone. And so you might have this backdrop where you have the unemployment rate going up, but in the past, when the fiscal side of the equation is also expanding, consumer spending tends to weaken but doesn't tend to decline outright. And so it's a pretty unique economic environment. You can go back to about 1970 and 2001. In 1970, we had the unemployment rate go from 3.5 to 6. Consumer spending bent, but it didn't break. Now, in 1970, you had Lyndon Johnson's Great Society, you had the Vietnam War, you had a lot of fiscal pressure. In 2001, you might remember in the late 90s, we had a surplus. And so we redistributed it back to households. 2/3 of households got up to $1,100 in today's money in 2001. And so it's during times like this when you have a backdrop that's deteriorating from an employment standpoint that big deficits can actually give enough people enough money to keep the consumer kind of humming. Bottom line, what's coming up is an unusual economy, we think, that's kind of propped up on the surface, but it doesn't look the healthiest on the inside because it has some winners and it has some losers. And on the next page, you'll see that the low-end consumer is really the big loser. If you go to the next slide, Peter. The lower-end consumer has felt like they've been in a recession for quite some time. The lower 20% has nearly no financial or real estate assets. They essentially have all cash or cash equivalents. That group is, adjusted for inflation, 18% poorer than they were at the end of 2019. And this is coming at a time when, even though inflation has slowed to the 2% target, there's a big bifurcation in terms of what's going on in the non-discretionary versus discretionary items. On the non-discretionary side, we have healthcare, we have auto insurance. I don't know if the next slide is coming. Auto repair.
Dave, which slide can you see right now?
I can see the growth backstop by loose fiscal policy. I don't know if that's what other people see, but that's what I see.
Advancing. Hold on one second here. Let me restart it. I'm sorry, everyone.
It's all good. Got the same slide. There you go. So thanks, Peter. So the point is that we're in a bit of a bifurcated economy. This typically happens when unemployment is going up, but the government is spending enough and keeping certain people spending. And who is really having the poor side of this bifurcation right now is the low end consumer, who's felt like they've been in a recession for quite some time. If you look at the lowest 20% in terms of income, these are people who don't tend to really have assets. They tend to have cash or cash equivalents. And their cash in liquid assets adjusted for inflation has gone down in value about 18% since 2019, since COVID. And so people, the low end, they're very much suffering right now. And it's not just inflation overall, it's certain items within inflation that disproportionately affect the low end as well. We have two measures of inflation on the left-hand side. The orange line is what we call non-discretionary inflation, and the blue line is what we call discretionary inflation. Non-discretionary includes things like healthcare, auto insurance, repair, daycare, internet, cell phone plans, basically the things you need to be a member of the 21st century. These things are still inflating at about 5% year over year. And so these people have already kind of taken a bath from their cash point of view, but prices in this area continue to put the squeeze on them. And so we expect consumer spending in the aggregate to slow and not break. Who's going to be doing a lot of the slowing is the lower end consumer. So if you rely on them, you kind of have to give them an incentive to keep spending. And from this point onward, spending will be increasingly concentrated at the top. And I'm sure that some of you have different levels of the consumer that you appeal to. I'm going to switch gears to the next slide.
Dave, can you quantify that bottom
Yeah.
20%? What are you talking about? Are you basing that off like a average household income? What is that line drawn off at? So customers with household incomes of what?
Yeah, so the median household income is about $75,000, though those on the lower end tend to be around $25,000 for the household. That's the lowest 20%. And so again, I'm looking at the real liquid assets of people who are the lowest 20% by income. By and large, only about 40 to 50% of Americans have hard assets in the terms of housing and financial assets. These people are really just cash people, and inflation has completely eroded away a lot of their liquid wealth, which is really the only wealth that they have. If we go to the housing section, I wanted to talk a little bit about housing, which people requested ahead of time we talk about in particular. So a lot of people are talking about housing in terms of, the Fed is starting to cut interest rates. Mortgage rates will go down in 2025. And so the housing market will take back off. And I say not so fast. So even though the Fed is starting to cut interest rates, the Fed doesn't control mortgage rates directly. Based off of the path that the Fed is expected to cut interest rates, mortgage rates are expected to settle around 5.5% in the middle of next year, which is better than today's 6.5%, but it's not a whole lot better. We have a chart that is basically an affordability index. It's the house payment that you would pay if you bought today relative to what people are making in terms of their wages. And right now we're in the environment that has been the worst since the 80s from an affordability standpoint. And this is with 6.5% mortgage rates today.
Peter, can we get a slide change from you? We're seeing, I think we're seeing what you're seeing with the slide now, the next slide, and an orange pop-up. Can we just get your current deck?
Sorry, I'm having some technical difficulties. I know that the PDF was losing some of the slide titles. So first I tried to make an on-the-fly pivot to our PowerPoint.
Sorry to interrupt you.
No, it's all good.
I'll make sure we're giving you guys a good data here. Okay, let's try this. How does that
Okay.
look?
I just see PowerPoint, but if I guess you could flick it to the next page, that might do.
You can go to the view mode from there. I think we should be okay. I think you're in the
You
right
see
slide.
PowerPoint, but it's a messier slide.
No, I think we see what you saw. If you go back to that one that you were just on. And then just click. view
Affordability
from
is still a
the-
problem for housing?
No, yeah, the view from the current slide.
Yeah,
I-
we still see your window with PowerPoint still up, like with the orange ribbon at the top.
Okay.
It must be going on your other monitor.
Yeah. All right. I'm just going to switch back to the PDF. We'll just have to explain the slide titles, Dave. I don't know why we're losing them.
That's okay.
Sorry, everyone. There.
All right. Thanks, Peter. So if you look at the last slide, the chart on the left-hand side, which I have on the previous slide, is a affordability chart, which shows how expensive it is to own a house today. The higher, the more affordable. The lower, the less affordable. And you can see the orange line where we're at now. It's among some of the worst that we've seen in the last several decades. Like I said, mortgage rates are likely to settle around 5.5 by the middle of next year. And because of that, we will improve in affordability, but we'll be in a backdrop which isn't really the worst in decades. It would be kind of like the second worst in decades. So it is better, and that will stimulate some demand probably at the margin. But in really to get housing sales off the floor, we would need to see a bigger improvement in affordability and in rates than we're likely to get at the current trajectory. If you go to the next page, another reason why this is particularly true is that it's not just the buyer of the house that is priced out. Sometimes the seller is priced out of the housing market too. By that, I mean existing owners who refied during the pandemic, they're enjoying 3% mortgages. That chart on the lower left-hand side is mortgage expense as a percent of disposable income. And that's the lowest it's been since 1977. So this is a pretty big deal. People who own a home right now have the lowest cost of carry compared to their income than they've had in 50 years. And people who are not in homes right now are facing some of the most difficult affordability conditions in years. Why would you trade away your 3% COVID mortgage to go lock in at a minimum of 5.5 somewhere else? So it's not just the affordability on the buyer's behalf. A lot of the time, sellers need to move somewhere too. And the fact that they're priced out actually keeps a lid on inventory, actually keeps the home sales low. And I would say finally on the next page, when it comes to new construction, which I know people in furniture like to watch, even though there is generally a shortage in the existing side when it comes to inventories, there's a bit of a glut on the new side, because home sales today from home builders, so new home sales, they're about in line with where they were in 2019. Okay, so that doesn't seem that bad, but inventories for home builders are 50% higher. And they cannot make sales go any faster than 2019 levels, even after doing mortgage rate buy downs, even after cutting prices on their houses. And so until we get a more serious correction in affordability, until we get a more serious correction in mortgage rates, Inventories are going to remain really high. That bottom left-hand chart is inventories on the new single family side. We need to see that line come back down towards that horizontal line, which is kind of the pre-COVID bogey, if you will, for where new house inventories would be. We need to get down there first before we could see housing starts take off. And I'm sorry, I lied. One last slide. Another reason why these new homes are probably selling a little slowly is that we are coming off of the biggest backlog of apartment construction in US history. That's the chart in the upper left-hand side. And this is coming at a time when vacancy rates, which is the top right, are already above pre-COVID, and rents, which is the lower right, are now deflating on a year-over-year basis. So rents are already going down. Rents are already cheap compared to the cost of buying a new house. And there's a lot of inventory that's hitting the market this year and in 2025. And so the existing home market is likely to stay frozen. The new home market is going to continue to kind of struggle to move their inventory unless they concede on price. And they might even have a harder time doing so because there will be increased competition from apartments, which will become more plentiful and at the moment are a lot cheaper. So I'll stop it right there and hand it back over to Peter.
Okay, thanks, Dave. So we just have a few research disclosures here. I'll jump into some of the industry data that we have. And so this is basically the results of our Q3 furniture retailer survey that we just published this morning. So some of you on this call do participate in this survey every quarter. For those of you that don't, to level set what this is, it's about 10 to 12 various furniture retailers. In total, there's about 450 stores, and they give us our year-on-year sales on a written and a delivered basis percent increase. And so we aggregate all the numbers together into mean and median figures. And the idea is to provide a benchmarking tool to really assess kind of how the industry is doing, because we think some of the government data and other industry data out there is a little bit wonky. So this is intended to provide more of a real world, realistic picture. If you're not participating, you can certainly email me or call me, and we'd love to have you, and then we get you a copy of the report once it's published. So with that said, you can see here for Q3, sales were down 4.5% on average. On a median basis, it was down 5%. Now, this is written, not delivered, so real true demand. What was most interesting to me is you can see from the last couple of quarters, starting with Q3 of 23, that the written demand trend had been getting less and less negative, and that was highly encouraging. And then we took a step back here in Q3 where things got worse. On a go-forward basis, retailers expect a little bit better Q4. Similarly, we have a separate mattress retailer effort. A lot of people participate in both, and that's going to tell you the same story. This we published on Friday, and you can see that we have an overall sort of improving trend from early 23 that continued into 24, but Q3 took a serious step back with mattress sales on average down 6%. I think if we then dig a little bit deeper into the monthly trends, it's a little more revealing on what's going on. And so this is the furniture written sales year on year by month. And so what really stood out to me was that July and September were abnormally weak. In fact, they were the two weakest months of the year outside of January, which had some serious storm and snow disruption. The weakness in September was particularly surprising because you would have had Labor Day and the holiday period months typically see outperformance. You saw that in February and in May with, of course, President's Day and Memorial Day. So really sort of a strange data point here with September. And similarly, we saw this with mattresses. So kind of, again, like a kind of steadily, it's not clean because there's peak months and shoulder months, but we see a general improving trend. And then we just thought September was a bit of an anomaly where things really stepped back. So what I think has happened here more recently, and many of you would be aware, it's an election year. And so we think advertising industry-wide has pulled back. As we dug deeper on this, we found out that a company like Tempur Sealy pulled back on advertising after Labor Day. And so we think that has had ripple effects across the mattress industry. And I think the same thing has happened to the furniture industry at a more localized levels. Election advertising has just squeezed out and everything else and made the return on ad spend pretty poor for a lot of companies that normally would be advertising this time of year. And so we're still in this election period. I think October is also going to be a really bad month. But what we are hearing is that companies like Tempur Sealy they're not adjusting down the ad budget for the year. They're just going to make up for it starting November 6th, right after the election. So I do think you're going to see a return to pretty good demand with November, December, as Dave is talking about. Consumers slowly getting better, particularly the upper income cohorts are in relatively good shape with their balance sheet. So I think the spending power is there. There just needs to be some motivation, and advertising is what's going to get people to go out shopping. I want to dig into some of the housing specific metrics. Dave had touched on some of this, but just to kind of level set, we are right now at 6.32% on a 30-year mortgage rate. This is on a kind of a trailing 2-week basis, but you can see there's been a pretty sharp drop off here with August and September as the Fed cut rates. As we look at a shorter term basis, you can see here that rates have moved up just a little bit in the last 2 weeks. But importantly, when we did hit this 6.08% in late September, that was the lowest in 2 years. And again, we're at 6.32% right now. So we're still back to where we were kind of in early 2023. So what does that mean? Well, the existing home sales market has been remarkably sluggish. We're right now, and this is only through August, so I'm really intrigued to see how September data comes through. Not that it's going to be gangbusters, but I would expect it to be a little bit better than 3.9 million annualized. We are 24% below the long-term average, so we are in a very depressed housing market. On a year-on-year basis, and what it means for your business, I think this is an interesting chart in that we saw tremendous year-on-year declines in the back half of 2022 and the first half of 2023. And largely for 2024, we've seen very modest declines. And so I think this is, in effect, not removing a headwind entirely, but it's reducing a very meaningful headwind that we saw during this period with housing activity down significantly. And again, with slightly lower rates, and not that the housing market's going to go gangbusters, but I would not be surprised to see existing home sales start to drift up year on year in the spring as we start to hit that spring buying season. More real time, this was, I thought, some fascinating data on the impact of lower mortgage rates. And this is mortgage refi application data. So it did start to improve pretty nicely with rates coming down in the back half of 24. And then when you saw the sharper rate cuts that took place in September, we saw this big spike. And so September mortgage refi application data was up 149% year on year. And even October, where rates have stepped back up a little bit, October's still up 159% year on year. So this is obviously going to, if people are refining, they're doing two things. They're getting a lower mortgage rate. If you maybe had home buyers the last couple of years that have a mortgage rate set at 7 or 8%, or they're doing a cash out. And so we'll look at some of that data. But to even just put this in perspective, we are up 160% or so. But and we look at the total application data, and we're still at 20-year lows on a refi application basis. So we have a long way to go for people to lower their mortgage rate or to do cash outs. Taking a look at the cash out data, this comes out a little bit delayed, but this is through Q2. And you can see this very steep fall off. So not only was existing home sales down a lot in 2022 and 2023, but cash out dollars were down significantly. 2023 alone, cash out dollars were down $100 billion year on year. So very meaningful headwind on home improvement, and then we do think there's carryover into the furniture and mattress space. But with Q2, we did see a modest, but it was an increase, up 7% year on year. And again, this is through Q2. We've seen the refi application data spike a lot more with Q3 and then early Q4. So as this data comes out, we do think that the cash out data is slowly getting better. Here again, you're kind of removing what was a meaningful headwind and turning it into a slight tailwind. And lastly, for me on the housing front, this is one of my favorite slides, and it just sort of helps to kind of level set the health of the homeowner, is that mortgage holders today have a record amount of tappable equity. This is the amount of money you could extract from your house while still maintaining a 20% ownership stake. So it's $11.5 trillion. I just think two really interesting statistics here is that the average mortgage holder has $214,000 of tappable equity. And if you break it down further, there's 4.5 million mortgage holders that have over 500,000 in tappable equity. So as David talked about, rates coming down, not precipitously, but we do think as you move from the low sixes to the low fives, that does spur further refi activity. Just optically, people like having a 5 handle on their mortgage rate than they would rather have a 6. And I think if you get down to the 5.5 middle of next year, even low fives by a year from now or late 2025, you're going to just continue to see refi, tapping equity, and housing activity get stronger and stronger. Separate from housing, this is just an interesting statistic as we look at some of this weakness in recent months. Not a perfect indicator on furniture, but this is University of Michigan consumer sentiment data. It goes back decades. And they ask, is this a good time or a bad time to buy large household durables? That could be a number of things, but furniture or mattresses would certainly be large household durables. And we saw this survey metric getting better and better throughout 23 and into early 24. And then for some reason with the month of May, and then this has continued to get worse, that sentiment has also gotten worse. Again, not sure why. Some of this, I think, is election related. Just advertising has gotten squeezed out. So people aren't thinking about buying these big household durables right now. So I'm very curious to see how this sentiment changes as we get into November, December. Also looking at furniture on a big picture perspective, if we look at the personal consumption expenditures data, the chart on the left is on a real inflation adjusted basis. So think about this on a unit basis. And then the chart on the right is on nominal with inflation included, so more on a dollar basis. So we always get asked is, we know furniture has been beat up, but has it, fully corrected the COVID bubble? And our answer is absolutely. We think the furniture industry has been in a pretty severe recession for the last 2.5 years. And so on a unit basis, we are below the 2015 to 2019 trend line. So we think we've overcorrected the COVID demand, and we are due for a bounce. Nominal has not corrected, but there's also been structural inflation in the economy. We are seeing with some of our survey results and pricing studies that furniture pricing seems to be relatively steady. So we're not expecting to see any meaningful cut or reduction in furniture prices just because of this nominal data. This is something I've shown in the past, you guys may recall. So furniture has corrected very hard post-COVID. Not all areas of consumer have. So we do think furniture, is poised for a bit of a stronger year in 25. It's been beaten down. We think advertising dollars come back. Housing is a slight tailwind. I don't think it's going to be a gear that's going gangbusters, but do I want to make a bet on, what's doing better, furniture or personal care? I'm going to make the bet on furniture because personal care, we are seeing just some recent weakness now emerging with some of the beauty names. And this is on a unit basis, it's way above. Everyone replaced their makeup collection in 21, 22 to get ready to go back out. Same thing with their wardrobe. Same thing with travel. Sporting equipment's another one. This is one that's been surprising everyone how resilient this has been. But there are plenty of categories that got that COVID bump or bounced off the COVID decline and it kind of overshot their gains. Lastly, more on a stock specific side, I know that the topic of Wayfair and online home furnishings is always of some interest. And so I just wanted to provide an update on what's going on at Wayfair. And I think the best way I can encapsulate that for everyone is just to show you their stock price. And this is over a 10-year period. So this is certainly not the stock chart of NVIDIA or Meta or Google. This is a very challenged stock chart. You know, the Wayfair is at $52 roughly today. So it's basically kind of in line with where it was 7.5 years ago in the first half of 2017. You could see, you know, there was significant sales and profit growth during COVID, and then the company overinvested as sales are rolling over, and it has been kind of flatlined since then. So Wayfair, like many tech companies, are now focusing on profitability. And so it's a very different culture, very different backdrop than pre-COVID, when Wayfair ran at significant EBITDA losses and was investing aggressively, hiring aggressively, you know, launching into Europe. They are still trying to grow, of course, but they are not hiring. In fact, they're firing. Just saw yesterday they're closing one of their Castlegate facilities. So they are trying to grow responsibly, and I think that allows for a better backdrop for people in the traditional brick and mortar world. And yeah, Wayfair will grow and will take share, but it's not going to be irresponsible growth. They had got some headlines, and they opened up one big Wayfair store in the Chicago area. It's just one store. I mean, it's going to take them years just to get any traction with that, with multiple stores. So I wouldn't worry about that too much over the next 3 to 5 years. So that's what I want to say about Wayfair. Talk about some other names. I know like Big Lots is in bankruptcy right now. And I think that's going to free up a lot of sales in the furniture space. They've already announced the closure of 550 stores. I think there could be more to come. They have a total of nearly 1,400. But with that, we will wrap it up from the presentation, and then happy to take any questions from the audience or from Shannon.
I think you're on mute, Shannon.
It'd be so wonderful if I wasn't muted, wouldn't it? If you guys have any questions, please throw them into the chat. These guys are incredible. Thank you guys for giving us that doom and gloom just to really shape out our Thursday. It's heard some really, I mean, that's some rough news coming out of Q3, right? That sales have taken that rebound, and hopefully, you know, the season that we'll see in spring will lift some housing sales. One of the things that we talked about kind of early on is just tactic. I think if I'm sitting in any retailer's seat right now, I'm looking at these numbers. I heard one tactical piece, which is holding advertising spending to be after the elections. I saw that in your report earlier this morning, Peter. Just because there's so much election advertisement noise. Is there anything else that a retailer that might be listening saying, great, this is all really good information, but what do I do with it? What other things should they be considering? I mean, we're coming off of some tough times and looking to, you know, are we scheduling flat for next year? What's the best, you know, what are some things that they should be considering taking from today's information as a retailer?
Sure. Yeah, I mean, I hopefully I don't want to be all doom and gloom. It's just, we know that the last month or so has been very challenged, and I'm assuming people on today's call are seeing that. I think our message for Dave and I is that it's not the consumer or your core customers getting worse. We're just in this air pocket right now, and we do think there'll be better days ahead in the very near future as we look to November, December. So, you know, what are you doing? I think you're looking at how can I get my advertising voice out stronger when I think the consumer will be back and the advertising rates will be more reasonable. And I think that's on the not too distant horizon. There is a lot of tariff talk that's picking up now. So obviously the election's still a bit of a wild card. It seems like some of the odds are moving towards Trump. To cover a bunch of tariff impacted names, which are all actually down quite a bit today. So tariffs are becoming more of a topic. Just thinking about where you're sourcing your products from. That's something you can get ahead of. Our DC policy team is saying that we need to take tariffs very seriously with a Trump victory. He is threatening 60% tariffs on China. Maybe don't take that as a literal number, but take it as a starting point in a negotiation and expect some type of tariffs. that Trump was vindicated by tariffs in his first administration, that they worked, they did not crash the economy, and so he's even more intended on doing them again. And then lastly, I just think it's some of the basic blocking and tackling. Don't be cutting costs. So thinking about we're through the worst of it. Those companies that are leaning in on employees, on training, on advertising, when the demand comes back, we think those are the companies that are going to take the most share coming out of it with a better demand environment. The last point I do want to make, I think on the mattress space specifically, where I believe advertising does drive significant demand, most of the larger companies that we track, like a Sleep Number, like a Mattress Firm, Tempur, almost everyone except for Tempur has pulled back on advertising. So mattresses are inherently 70% at least are discretionary replacement. I think as housing starts to become a small tailwind as we get into 25, companies like Sleep Number, Mattress Firm talk about free traffic that they would like to advertise around. In the absence of free traffic, everyone's pulled back. So you start to see a little bit of actual demand improvement. I think you see these bigger companies start to then come back in with advertising, and that starts to drive more and more demand. So that's something whether you can just try to participate in or take advantage of. And that's where I think, on the hiring and advertising front, thinking about leaning in yourself, because there's definitely going to be share winners and share losers as the industry rebounds over the next 2 years.
That's great insight. Peter, Kenny had just said a question, and do you happen to see more consolidation in retail or supplier base?
I mean, I think so. I mean, I look at Big Lots has just declared bankruptcy last month. 550 stores closed. There's a stalking horse bidder right now. I covered Big Lots for a long time. I know they're losing significant amounts of EBITDA. We'll see how the profitability looks coming out of bankruptcy and the store closures, but there's a lot of troubled retailers, a lot of troubled companies out there. You saw obviously Conn's and Badcock was one that went belly up very quickly. So it is still challenged. There are companies that we talk about advertising. They can't afford to advertise. They're still too levered with their debt. Their debt's coming due. So I think you're going to continue to see consolidation and market share come up for grabs. And that's all the more reason to run your business responsibly, but tactically trying to position yourself to advertise, hire, grow, and to take share, because there is going to be a lot of share out there to take.
With some of the unemployment rates now being the problem, for the Fed, what are you expecting for the rate cuts in the short and long term?
Right. So for the short term, we have about 50 basis points priced in. So when the Fed cuts, they tend to cut 0.25% or 25 basis points at a time. The market, and we expect about 2 of those by the end of the year. It could be as much as 4 by the time we get in the middle of next year, which is what I'm basing my estimate on 5.5% mortgage rates on. And then likely 6 by the end of next year. Now that's based off of the current trajectory. That's kind of priced in the market, and that's in line with the guidance that the Fed has given via its forward guidance. The dot plot is, they just give you an idea of what they intend to do. What could change what they intend to do would be, I think at this point, what happens in unemployment, because inflation, I wouldn't say it's like a completely gone concern, but it's not the number one concern right now. If unemployment goes up very aggressively, let's say it goes back above 4.5 by the end of the year, I would expect there to be more cuts. But in the event that the unemployment rate kind of levels off, doesn't go much higher, then I think you could expect a little bit less. The kind of middle road is, again, 2 by the end of this year, 4 by the middle of next year, 6 by the end of next year.
Do you happen to know what segments of the industry, or like what segments unemployment's hitting the hardest? Like, where are those people coming from?
Right. So there's this indicator that's called the SOM roll, which is basically when the unemployment rate moves up a 0.5 percentage point within a year. That's usually a pain point. Oftentimes economies can be in recession when you do that. And there's about 20 states that have triggered the SOM roll right now. A lot of them are kind of states that you might expect that are not the most business friendly, like California and New York. But there's also been a pretty long manufacturing recession in the United States. In the same way that we've had a furniture recession for about 2 years, we've had manufacturing recession for about 2 years. And so a lot of people in areas that are along the Mississippi, the old Rust Belt, they're being affected as well. There's a lot of talk about how the unemployment rate is going up strictly because of immigration. We're really big sellers of that idea because you can look in the unemployment rate. They actually break apart, who are the unemployed people. And really, since it started going up, about 80% of the increases come from job losers. Those are people who are telling the government, I'm unemployed because I lost my job. About the other 20% are people who are reentrants, who are people who are saying, look, I was previously retired or not in the labor force. Maybe something forced me back in. Inflation has made it so that things are not as affordable. So I need to go back into the labor market. So it's really a bifurcated thing. There are some communities that are really facing hard unemployment, but there are some areas that are not. And the question now is, do those weaknesses continue to spread out, or do they remain contained?
Really good insight. I think you guys are giving us some great insight. Tough times make great companies, right? And so, right now we could look at this as this, obviously there is the negative impact everyone's feeling with this. Declined sales is directly correlated with, with this unemployment rate. And so there may be some indicators that maybe that's not going to change drastically over the next 6 months to 12 months. However, we also know that when times are really good, one of the biggest, things that we're hearing is it's impossible to find talent. There's no good people out on the market. And so I think it's good to say that these are the times where companies get strategic and look at what are the resources that I have in front of me? How do I capitalize on them? What's my strategy from here? And, it's not always a buy and hold. It's not always a, survive through 25 strategy. This is a great time as well to, was it, I know it's Keith Koenig that said it, but I think, someone else said it before him, but you never waste a great crisis. And so, this industry is extremely resilient and has endured a lot. Oscar, thank you, Tracy.
Yeah.
Great. You're gonna say something, Dave?
Oh yeah, no, I actually want to double down on kind of the optimism because, it's kind of it's kind of funny to say, but from like the economist perspective, when you have an increase in unemployment because people are getting laid off, it's because companies are, trying to reduce inefficiencies that they have within them right now. When you start to have, ugly episodes like 2008, whatever, that's a lot of people doing that at the same time. But ultimately, these are, a fact of the kind of the economic cycle. These are necessary changes to lay the foundations for long-term sustainable growth. So, always try to see the upside in everything.
That's a valuable point. I think I had saw something about like tech was one of the big areas that was heavily impacted, whether it's on the development side or the sales side. I think that there's some great talent that's floating out there that had heavy investments from VCs to grow these tech companies. And now you have this incredible talent sitting out there in the market that had to be paid, way, way, way above market value to even land at, these top quality companies. They're not there anymore. And you have these, ripe opportunities for industries like ours that are investing in these spaces. And there's some great people out there that market value looks very different. It's an employer's market from that standpoint. And we're hiring as well, and we are talking to some candidates that say this is the first time that I've had a hard time getting interviews in a very long time. And so, from that perspective, I think it's a really great and optimistic opportunity. Any other questions that you guys have before we wrap up with Peter and Dave? All right, Peter, Dave, any last things that you guys would like them to walk with? If they're walking away with one thing, what is that thing that they should be walking away with today?
Get ready. I think come November 6th, we're going to see demand come back. So it might feel tough right now, but I'd start getting your game plan in for Black Friday weekend and early 25, because I think you'll see a much better demand environment than what we've had the last several months.
Yeah, I would just I agree that aggregate growth could pick up after the election, but I think the number one thing I'm focused on is to be mindful of this budding bifurcation that's across the income group for consumers. I know that a lot of people who buy furniture might tend to be in the single family space, so maybe not a whole lot of people has a whole lot of exposure to the very lowest. But if you do depend on them in some way, I would really take note of that, and take note that the opportunity is really up income. So that's the number one thing that I would take away from this.
Great. Well, I want to thank you guys. One of the strategies they did say was, to getting ahead of this conversation about tariffs. If any of you guys are interested in some of that conversation, we do meet with our lobbyist every 2 weeks in a webinar type environment, but it's an interactive environment. Feel free to shoot myself or anyone from the Home Furnishings Association an email if you'd like to come. We do those every other Wednesday. So we'll be meeting next Wednesday at 3 p.m. Eastern. I would love to thank our panelists for today, Dave Wigglesworth and Peter Keith with Piper Sandler. Guys, thank you so much. We love our relationship with Piper Sandler. Thank you for everything you're doing to help us get insight onto, just how up and down this economy is. And thank you guys for all attending. Well, you can rewatch this. We'll have this available later this week on demand on our website at myhfa.org. You should also get an email recap. And again, thank you to our sponsor, Synchrony, who makes these webinars possible. Y'all, we had a tough quarter. Things are looking up. You heard it first from David and Peter Keith, sorry. We're looking forward to Black Friday and beyond and getting past this election. So hang in there. We're surviving through 25 and keep sales great. If you need anything, you know where to reach us here at the Home Furnishings Association. Take care, y'all.